Welcome to Islamic Finance for everyone.
Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome back to Islamic Finance for Everyone. When we look at the classical Islamic legal text, the prohibition of Maysir is often explained through tangible historical examples, games of chance, betting on racing animals, or casting arrows for shares of meat. But we no longer live in a simple barter or early mercantile economy. Today, financial risk has been completely unbundled, tokenized, and turned into complex commodities. Trillions of dollars move daily through instruments that never touch a physical factory, service, or asset. As an academic and financial researcher, the question I am most frequently asked by market professionals and retail investors alike is this: how do ancient Sharia prohibitions apply to highly advanced modern instruments like options trading, crypto speculations, and conventional insurance? In this third episode of our masterclass series, we are taking a direct look at modern financial engineering. We will expose exactly where contemporary instruments cross the line into zero-sum Maysir, and more importantly, discover the Sharia-compliant alternatives designed to build true economic value. Let's begin at the absolute core of Wall Street's financial engineering: derivatives, specifically conventional option trading. A call option gives a buyer the right, but not the obligation, to purchase an underlying stock at a set price within a specific time frame. Proponents argue this is just a sophisticated tool for hedging risk. But let's look at the actual structural mechanics through the definitive lens of the reference framework we established in our earlier sessions, the rule of Al-Ghunm bil-Ghurm, gaining wealth purely at the expense of another absolute uncompensated loss.
In a conventional options contract, the buyer pays a cash premium to the seller. If the market price moves favorably, the buyer profits directly from the seller's wallet. If the price moves unfavorably, the buyer's premium is wiped out entirely, becoming pure, effortless profit for the seller. No underlying stock changes hands, the contract is settled purely on cash differentials.
This is the exact mathematical definition of zero-sum game. The risk being traded is not an inherent operational byproduct of manufacturing goods or providing services. It is an artificial hazard created entirely by the contract itself. Under Sharia jurisprudence, you cannot detach risk from asset ownership and trade it as an independent commodity. When you buy or sell conventional options, you are not trading property or enterprise value. You are trading pure probability. It is digital roulette wheel wrapped in the corporate legal framework. This exact same mechanical vulnerability explains the massive speculative crisis inside the digital asset space. Let's make a critical distinction. Blockchain technology and functional utility digital tokens are not inherently problematic. However, the vast majority of retail activity inside the crypto ecosystem has nothing to do with the technological adoption or decentralized utility. Instead, it relies on creating a synthetic environment engineered for overnight enrichment, the classic trap of Yusr.
When digital tokens are minted with zero structural utility, no underlying cash flows, and no asset backing, their entire market capitalization is driven by the greater fool theory. The purchase is made solely on the speculative expectation of flipping the unbacked exposure to another buyer at an inflated price before a market collapse.
When an asset class generates zero productive economic labor and serves no macro utility, it ceases to be a medium of trade. It transforms into a collective betting pool. If you are buying highly volatile meme, tokens, or unbacked digital assets purely to capture short-term price swings without any care for project fundamentals, you are no longer practicing investment or commerce. You are operating on raw probability, mirroring the behavioral and economic characteristics of pre-Islamic qimar. Now, Let's look at an institution that touches almost every household and business globally. Conventional commercial insurance. On the surface, insurance seems like the exact opposite of gambling. It is designed to protect you from catastrophe. But from a structural engineering perspective, conventional commercial insurance is built on a severely flawed transaction metrics. You pay a fixed premium to a commercial insurance provider. If an accident occurs, the company pays you a large sum. If no accident occurs, the company keeps your premium as a pure profit, leaving you with zero return. This creates an exchange where one party's gain is the other structural loss, meaning the contract itself embodies the mechanisms of Maysir and 𝗬𝗺.
The core structural definition of gambling in Islamic commercial law rests on the maxim of Al-Ghunm bil-Ghurm, a transaction where one party's absolute profit, 𝗀, is mathematically mirrored by and extracted directly from the counterparty's uncompensated, absolute loss, 𝗀.
In a Takaful framework, participants do not buy a risk protection from a corporate third party. Instead, they contribute their premiums as tabirru or voluntary donation into a shared cooperative pool. The fund belongs to the participants collectively. If a member suffers a loss, they are compensated out of this shared pool. If a surplus remains at the end of the fiscal year, that money doesn't become corporate profit. It is distributed right back to the participants as a surplus return or held as a reserve. We have effectively transformed a predatory zero-sum commercial game into a highly ethical positive-sum system of mutual social solidarity. Navigating modern global markets requires a deep commitment to financial literacy and ethical precision. We don't have to compromise our principles to access advanced financial liquidity or risk management tools. If you are determined to build a thoroughly clean, blessed wealth and master the intersection of modern finance and authentic Sharia principles, take a quick moment right now to hit that subscribe button. Turn on notification bell because our masterclass series is expanding. Let's open our international digital boardroom. Comment below right now. Have you ever been offered a financial derivative, a crypto asset, or an insurance policy that left you feeling ethically uneasy? How did you handle it? Drop your thoughts, case studies, and questions below. Whether you are analyzing markets in Jeddah, structuring fintech platforms in Karachi, or managing an investment portfolio globally, let's keep this conversation active. To close out this core third installments of our series, let's establish our permanent structural filter to test any modern financial innovation before deploying capital. First, verify the risk model. Is the risk an unavoidable byproduct of a real asset or enterprise, or is it a synthetic hazard manufactured solely to be traded as a commodity? 2. Evaluate the payout metrics. Does the financial instrument operate as a strict zero-sum game, or does it utilize a positive-sum cooperative risk-sharing framework? 3. Confirm fund ownership. In a risk mitigation structure, does your premium become uncompensated corporate profit, or is it managed via transparent cooperative Takaful pool? When we apply these rigorous structural benchmarks, we protect our portfolio from modern speculative traps and align our capital with genuine economic justice. Thank you for watching Islamic Finance for Everyone. Keep your transaction transparent, your wealth asset backed, and your earnings blessed. Share this masterclass with your professional and investment networks, and I will see you in our next deep dive. Finally, this is the end of our season, and we'll have a summer break. I'll see you inshallah after the summer vacations, hopefully starting new series in September. Until then, جزاكم الله خيرا والسلام عليكم ورحمة الله وبركاته.
If you found this explanation helpful, don't forget to like, subscribe, and share this video with your network. Let's spread the word about ethical and inclusive finance. Follow us on social media platform for more insights into Islamic finance.